Agro. I'm the president and CEO of Revival Gold.
Hugh, good to see you, sir. Good to see you. Busy time, great time for gold, and I know you've been well, I guess hard at thought, really, with regards to the projects in terms of how you kind of prioritize first production. And I've got to ask myself, does the market conditions sort of change your thinking between Mercur and Bear Arnett?
Well, yeah, as you know, we're fast tracking Mercur because it is on private land. It will permit faster than Beartrack Arnett. That doesn't diminish Beartrack Arnett. It doesn't diminish the exploration potential there. We see already at 4.6 million ounces of resource. We think there's at least another 3 million ounces there to develop into that project. But the market is with us today, the gold price is with us today, and so we want to try and meet that opportunity with production. And to do that fastest, we turn to Mercur. And so that's where our focus is in terms of work programs right now, and lots going on. It's an exciting time.
It is an exciting time, but just to kind of help people need the story, just understand that kind of relationship between Mercur and Beartrack Arnett. Obviously, you talk about permitting being a sort of a kind of driving factor there, but Beartrack Arnett also has a kind of heap leach restart component to it, so which helps. So how do you look at the portfolio at the moment?
First up is, we've got a plus or minus 100,000 ounces a year of production potential from open pit heap leach at our Mercur project in Utah. As you know, Matt, it's about a 2-year permitting timeline for that project because it's on private land, because it's in a dry location, because we've got existing infrastructure and technical data that allows us to move more quickly, proven past producing site. So the program this year is focused on moving the PEA that we completed a couple of months, 3 months or so ago, into a PFS. And in order to do that, we've got resource upgrade drilling to do. We've got sample collection to do for metallurgical column tests to expand our metallurgical data for the project. We are also working on permitting preparations and plans, and we've already started some of the baseline collection aspects in respect of archaeological data. That serves us as we expand our drill permitting, now with 6 drill permits on the Mercur project. And then also it will facilitate the archaeological test work we need for the purpose of restarting the mine. So all of that work's already underway. In fact, we've got road construction going on, pad construction going on for drilling purposes. We're expecting the first rig to arrive here in the next week or two, and the second to follow. So busy time for the team on site at Mercur, and that's the priority for us right now. We do have activities planned for later this year at Beartrack Arnett, and we're continuing to move permitting preparations ahead for the first phase heap leach project at Beartrack Arnett in Idaho. But in terms of the news flow that investors can expect, it'll be first out of Mercur here as we move forward with drilling.
Okay, and that's so how many meters did you say? 13,000?
Yeah, we've got about 10,000 meters of RC drilling and another 3,000 meters of core drilling, so a total of 13,000 meters, 2 drill rigs underway.
So what's the goal there? Resource conversion, expansion, or deeper discovery, or all three?
All three.
Okay.
Primarily the first one, though. We've got about 40% of our resource in the inferred category, so we'll want to convert that to measured and indicated. So that's job one. There's opportunities to expand on the peripheral of the existing resource, in particular in the North Rover area, and also in our South Mercur area. So we're looking to do some of that. I'm not sure we'll get to that third target of deeper drilling at West Mercur this year, but that is definitely on the horizon. You'll remember this is a Carlin type deposit. These are very large systems. We've got about a 7,000 hectare land position, and we know that there is deeper potential because back in the late 1800s and early 1900s, there was artisanal mining activity going on out in these locations. Nothing of a modern sense, and not very much in terms of exploration, with just 0.5% of drill holes beneath 400 meters below surface. So that's a tantalizing target for us down the road.
Okay, and obviously given current gold price at the moment, everyone's interested in how you kind of, you're almost assured profitability. It feels like, but you've got to control what you can control. So some of those variables which affect that, such as heap leach, what kind of confidence have you got given the kind of past production history and your own kind of metallurgical work recently?
Well, one thing about the current rise in the price of gold is that we're not seeing a commensurate rise in the price of fuel, oil and gas. So I think that means that margin expansion is a possibility here. We're seeing it in the majors and in the intermediates with their results, putting a lot of cash on their balance sheets. We were talking offline about the state of the Canadian banks which service the mining industry. They're scrambling to find projects to fill their credit requirements because these senior and intermediate gold companies are paying down debt, and there isn't a lot of that sort of credit available for them. So they're looking at building their pipelines just as investors and corporates are building their pipelines for potential future projects to develop and be a part of and fund. So, look, I think we do have margin expansion possibilities with this rising gold price environment we're in. Recall that the Mercur gold project in Utah, which we're advancing, 100% held by Revival Gold, has got a $500 million, a $750 million NAV at $3,000 gold. So that's a lot of NAV in our company for a market cap of about 1/10 that, just in the one project.
Okay, well, so looking at some of these other variables, like I say, I want to kind of deal with the kind of technical first before coming back to kind of the vision, I call it, for how you kind of advance this company, is looking at the potentially. Well, in fact, let me start. How do you look at, in terms of the simplicity of the processing? You're talking about, I think, a conventional ADR, no agglomeration required. So, what are the things that you are thinking about and setting up at Mercur with regards to a technical execution perspective?
Well, the key part of our de-risking in the next phase of technical work will be around metallurgical recoveries. We in the PEA have a metallurgical recovery of average 75% from the heap leach process. And as you point out, 3-stage crush, no agglomeration to half-inch crush size, and then the solution delivers, and the 8R plant delivers that 75% recovery. But the data behind that includes the 5-column tests we did last year, which had recoveries in the average of 84%. And so we want to expand the metallurgical test work we have available to us across the deposit to be able to make sure that we really understand the metallurgical recoveries in our next phase of study, so the PFS, which is to follow next year. And then also to look at variability across different crush sizes. There's a trade-off at some point between doing a fine crush, a half-inch crush, versus maybe a coarser crush. Maybe we go to 2-inch crush and we use less cost input into the production of the gold, slightly give up on our recoveries, but ultimately a higher value project. So we need to do some of that trade-off study. We need to get a broader sample base for our studies. And there's an opportunity for us to potentially improve on recoveries, optimize on the trade-off between value and how we go about the technical work. So these are some of the things that we will perfect as part of the next phase of work in preparation for a PFS. I would say metallurgy is a key focus area. Infill drilling is important because we want to build a better geological model for the next phase of work, take risk out of the project, but also look for opportunities, because as we get to the outside edges of the current resources, there's no reason to expect we might see potential to grow beyond what's been drilled off previously. So those are opportunities to improve on the project, lower risk, and that's the focus of the program this year.
Okay, and so just on that, and something you said earlier with regards to kind of the shallow drilling so far, what are you chasing at depth? What sort of grade or structure, and what data have you got that's sort of driving that thinking?
Well, the first thing is we're in a large gold system. Again, Carlin type systems. Actually, this is the first Carlin type system identified in the US, but we've seen how these Carlin systems go from surface mining to underground mining so successfully in places in Nevada. For example, 4 Mile, the real focus on underground that Barrick is so excited about with their joint venture in Nevada. Also, Cortez Hills, another situation. The Mico mine was a deeper situation on the Goldstrike mine. And so there is a thumbprint of what these things look like and where they can go. We haven't got any deep drilling on this project at Mercur, and nothing of note. There are a couple of holes that go deeper. We do see structure, and what we're going to look to is some of the more advanced geophysical tools and further drilling to find traps where we could have concentration of mineralization. And again, I would observe, that the gold tends to be where it's been found before. And we know that historically the artisanal miners were mining in underground situations to the west of our Mercur project. And we have some tenor on grade. Historic production in the order of about 1 million ounces at 7 grams per ton gold is a good indicator that there is high grades in the systems and open potential across this 7,000 hectare property. So look, this is one of the keys when you get into a situation like this where you've got organic growth potential. You absolutely want to continue to unpeel the onion, so to speak, and show that potential. Especially when we're attracting a lot of industry interest with our projects. I mean, we don't want to leave anything unrevealed while we are in this situation of building up value in the initial phase of work with our heap leach project. That first plus or minus 100,000 ounces a year.
Okay, and with regards to the current infrastructure there in terms of what power, water, roads, whatever, what percentage of that is in place? How much more work is to be done, and over what time frame would you look to address that?
Well, I think we would address that over the construction period of about 1 year. The things that take a lot of time in developing out a new project are getting roadways in, getting power in, getting water, because you think about it, you need those things to be able to get that construction site going. So in that respect, we really benefit from being close to a town of 40,000 people. That means we don't have to establish a camp. We don't have to establish a fly-in, fly-out crew. We've got roads, so we can get immediate access to the project area and what we're doing there. We've got an office location. We're set up to be able to start work relatively quickly. The fact that we've got power to site already means we don't have to wait for the power line to come in or the permitting related to that. So those things really speed up our workflow. The other thing is we know how the site works, and this is a softer thing to qualify, but if you know how the equipment will work on the site, if you know how the rock performs, if you know what is optimal in terms of how to get around and who to work with and who to have doing things on the site and how to work with the regulators, you avoid some of the pitfalls that come from frankly from learning, from learning what the site is going to deliver for you. And I must emphasize, every mine is a different black box, right? It's a new project. There isn't a cookie cutter mine. They're all different. They come with different environmental factors, different social factors, different technical factors, and all that information we have from working on this site previously lends itself to our being able to move more quickly with that construction aspect, which again we think is going to be about a year once we're complete permitting. So roughly speaking, as we see it right now, we've got about a half a year of permitting preparations and the start of data collection, 2 years of permitting. So that's 2026, 2027 timeframe. While we're doing that, we'll finalize a PFS and an FS construction financing, and by early 28, we want to be in construction. That's our objective.
Okay, get ready for a multi-question question. Look, I think that with companies, there are always moments that you look at and you go, that was a kind of step change. That changed the fortunes of the company. And I think you would, well, tell me when you look back at the decision to go with Mercur, what you think that did for you. And then I guess secondly, what does that mean for Beartrack Arnett in terms of the pace at which you advance that, the pace at which you move that forward, and even, quite frankly, even the way that you come at that project?
So the way we think about it is with a longer term lens, right? So what we're trying to achieve is a multi-asset platform, growth in gold, in good geography, and one that is a sustainable business that makes a lot of money for our shareholders. So that's our overall objective. And the way we do that, I think in this environment, right, where there is such a healthy gold price, is to move as quickly as possible as we can into production, and to do so in an efficient manner. In other words, we don't want a $1 billion project that's going to soak up a lot of time, complexity, and capital to get to that goal of production. What we're looking for is plus or minus $200 million for our first phase of work at Mercur. It takes us into production for plus or minus 100,000 ounces a year. Look, more details to follow as we progress over the next couple of years here, but that's our objective. And meanwhile, we'll continue to progress the Beartrack Arnett first phase heap leach project forward. That's another 65,000 ounces a year. So that takes us up to plus or minus 160,000 ounces a year from two projects, both in the western United States, both with relatively simple heap leach processes, both taking advantage of brownfields infrastructure, extensive technical data, and that are right across the wheelhouse, right across the plate, and in our wheelhouse to deliver. That's a pretty compelling opportunity right there. That's about $500 million of NAV at $21.75 gold. It's about $1.2 billion worth of NAV at $3,000 gold. That's a pretty exciting prospect right there. But that's only 2.5 million of the 3 million of the 6 million ounces of gold that we have in resource. And so, what I think is particularly interesting about Revival Gold is that we don't have to go anywhere else to acquire future growth. We have it organically. And so in that sense, I'm trying to answer your question, Matt, but in that sense, we have very complementary projects. Mercur going into production to deliver free cash flow from which we can deliver future exploration value and growth potential out of our Beartrack Arnett project.
No, I hear you, and I do get it. But I'm thinking about things like, if I look at Joss, you kind of got this high-grade component. Does that open up underground for you? And if so, do you need more time to think about that? And how do you phase that if it is part of the solution going forward?
It will be part of the future of the project. It's that organic growth that I was speaking about earlier. And what's the first step with that? More drilling, more exploration. And what's the benefit of that for our shareholders? Exciting, sizzling results. And we'll be doing some of that later this year. I'm really looking forward to seeing what comes out of our Joss extension drilling. I know our chief geologists, our VP engineering development, have spent a lot of time developing up what that could mean for our stock in the way of NAV. It's very compelling.
And what does the kind of made in the US component do for mining companies at the moment? It's meant to be. I'm hearing lots of CEOs tell me that the US government is making things a lot easier, removing red tape, etc. How does that help you?
Well, in the immediate term, not very much, to be frank. I mean, we're in Utah. We're on private ground, so we don't really intersect with much in the way of federal approvals. Really, we're in a good spot already. Maybe down the road it helps us with the Beartrack Arnett, which is on federal land and which could benefit from better policies. But what I would step back from the immediate, rhetoric and the messages coming out of the White House about Made in America, and I'd say that I think broadly speaking, whether you're in Canada, the UK, or the United States, there's a recognition that we want to be bringing both our sources of materials and our sources of manufacturing and services and goods all back home. And it's that value, it's that value chain, that supply chain, and the integrity of that supply chain, which I think the general population has come to realize is key to the safety and security, of our countries and of our economic systems. And there's a further point I'd make, which is, British mining engineers, Canadian mining engineers, U.S. mining engineers, we do good work. We are conscious of what we do. We have the tools and the technology to do good work. I wouldn't say that's the case or the requirement or the level of the playing field elsewhere in the world. And I think people want to see responsible actions and results out of modern mining, and we can deliver that.
But do you think that kind of positioning for a company such as yourself is helpful when it comes to M&A, whether you're doing the acquiring or you kind of got people looking at peer comparisons and judging you against that? Is that genuinely a thing?
Absolutely. Yeah, absolutely.
Okay.
I mean, set aside the ESG interest of many institutional investors, and just think about it from a practical point of view. If you have the team that can deliver technical performance, operational performance, and do it in a way that's accepted and embraced by the community, that's a winning combination with assets like the assets we have. I mean, we can tell you, a lot of the corporate and strategic investor interest in Revival Gold right now centers on the fact that this is a team that's proven it can deliver. We've delivered gold from our Beartrack Arnett project for about $6 an ounce in discovery cost. We've delivered overall for less than $10 an ounce in our complete portfolio. We've delivered on time and on budget with our studies and our permitting and our results. I think that track record is just as attractive to potential funding parties and strategic partners as the actual physical assets. I really do.
Okay, well, tell me, how do I value a company like yours then? You've been on a little tear. You've maybe almost doubling your share price since beginning of the year when we were talking to you. Obviously, someone's listening, someone's interested, but how do I compare you to your peers? What should I be looking at with regards to your assets, and how do I get to a number which is going to make sense if you're saying you're undervalued?
Well, I think the way to approach it is a price to underlying net asset value. We are now at the stage where we're no longer just an exploration company where you use a relatively dumb metric of dollars per ounce in the ground. We trade very inexpensively on that basis, but I would direct investors to look at equity research on Revival Gold, which compares our price, our share price, our market capitalization to the underlying NAV in our company. And that metric today is about 0.15 price to underlying NAV. In other words, for every dollar of value, mine value, you get you're paying 15 cents right now in Revival Gold. And I would say that typically for companies like ours, we go through a stage of increasing price to underlying net asset value from somewhere as low as where we are today to perhaps as high as 60 cents on the dollar or 80 cents on the dollar once we're in production. So we've got in my simple world, a 5x lift in our stock as we move towards production. And so the trick, as you very well know and have pointed out to me in the past, minimize dilution on the path to getting there, shorten the path as much as we can, and deliver the highest potential return for our owners. So we're working through that now as we think about the next couple of years of work and the funding of that work and how we go about doing that optimally for our shareholders. And it's a really exciting time to have two big gold projects in the western United States with all the interest we see out there and the choices we have to carry ourselves forward.
Okay, well, talk to me about the internal team. I guess the bench strength needed to do that. some heavy lifting coming up.
Yeah, and that's why we have, starting with the board, the experience of our non-executive chairman who's done it before, Tim Warman, with Fiore Gold in Nevada, with a restart project successfully sold on to Calibre. We've got it in people like Larry Radford, the chairman of our technical committee, who has built, operated, designed multi-billion dollar portfolios of assets for majors, for intermediates. He's the former COO of Hecla, which is extremely relevant to what we're doing in Idaho and in Utah, of course, heap leach mill projects. Also on the technical committee, Norm Pritchard, who is former COO of El Dorado. So these are gentlemen who've done it before, and give us a lot of guidance and a lot of input as we think about the technical aspects of our projects. But there's other aspects. We have to think about the legal and governance, the social aspects. That's why we've got the former Chief Legal Officer of Hud Bay on our board, Maura Lendon. We've got the capital markets expertise of a gentleman like Wayne Hubert, who built up Andean from a discovery and $100 million market cap to its sale to Goldcorp for $3 billion in the last cycle. And so if you look at this complement of people, together with the chairman of our audit firm, who's the chairman of our audit committee, who's a wonderful person, Rob Chose, former CFO of Richemont, former CFO of New Gold, and of course in the finance group and team at Kinross and part of its earlier formation. So, that's the experience we have to be able to conceptualize, finance, technically design and build and execute on our projects. And the management team, benefits from that board expertise, and in itself has the capability and experience as operators, as technical designers, as permitters, as financiers for projects like this. I've gone on, but you asked the question, so I wanted to answer it, Matt, fully.
No, but I think it's important. Like you ask any sort of long-standing investor in the space, they're looking for the management team who can actually execute, right? Number one, and then two, having the substantial asset behind in front of them. So, does that help with access to capital? Does that help with, well, if you need to bring on strategic investors at this point, how does that, help, quite frankly, with that team?
It's huge. It's huge from everything from the quality of the work that those parties review. Most investors don't have the time or the resources, the inclination to do the deep dive to actually remodel a resource or test the financing assumptions or the technical unit cost assumptions. But any sophisticated investor, the type we're talking about now, does that work. And so they're looking at the work that you've done in the past, and they're assessing that versus what they see elsewhere and what they would expect to see. So that's test number one. Test number two is how the team will respond to suggestions and ideas and new developments. And then the third test, I think, is in whether the strategic and corporate folks we talk to want to play in our sandbox with our team. And we go thumbs up on all three of those tests as we go through these processes of entertaining interest in our project. It's an important part of the value building exercise to have a robust electronic data room, to bring people out to the project, to engage with them, to take on board their input, and to see what kinds of ideas they have for us on potential future involvement. That's an important value building exercise. We don't see a lot of it as investors, because most of it has to take place under confidentiality agreements beneath the surface, but it's a huge part of the value building exercise.
Okay, well, maybe next time we talk, we can talk a little bit about that. And I'll stay away from specific numbers because you've mentioned a few in there today, but I'm going to talk about the macro. What's driving the gold price at the moment? It seems to have like come off in the last day, well, since yesterday. But what's been driving it up until now? And is that sustainable?
Look, I'm no expert in the gold price, but my sense is that it's more to do with the erosion of the U.S. dollar as a central store of value, a globally recognized store of value. And we're seeing it in what central banks are choosing to do with their holdings. They're choosing to buy gold and move away from the U.S. dollar. In fact, gold recently succeeded the euro as the second most popular store of value for central banks. We've been on this central bank buying spree for about 15 years now, 12, 15 years. And I think that's what the underlying movement is for gold. And you can't get away with it. You can't get away with having a $37 billion deficit and the ongoing issues around having access to U.S. dollars, when they become politicized. So I think that's what's driving gold. It's a move out of the U.S. dollar and into gold as a more widely recognized and accessible store of value. I mean, there's other things going on, obviously, but I think that's the big theme. And listen, that's proven itself out over time. Over 5,000 years of human history, gold has been a consistent and reliable store of value. And that's why we're in this business, to produce something that's got long-term value. And to do it, obviously, we want the extra bump of not just betting on the gold price, but betting on smart people to deliver gold from rocks at an exciting margin, which gives even more leverage to investors through and value for their money. The best way to look at it, Matt, is to think about it in terms of the exposure one gets in a company like Revival Gold. Every 1,000 shares of our company represents about 30 ounces of gold in the ground. So not only do you get leverage to the price of gold moving up, but you also get leverage as we take the company forward, the assets forward, and start delivering that gold to refineries and to the ultimate end market. So it's a pretty exciting value equation. Today we're trading at about $13 an ounce in the ground. By the time we mine it, the margin on it at current gold prices is going to be well through $1,000 an ounce.
And that's a good enough reason for retail to look back in at the company so you can execute.
I think it is. I do think it is, and I think this is a great time to be buying a diversified portfolio of developers in good geography with solid teams and a compelling value story like Revival Gold.